you have a wife and you have girlfriends, and the wife is maybe permanent and girlfriends are come and go. And optically, long term, I would say 10 years Treasury or a 30 years US Treasury is, of course, unattractive. That we all agree, because interest rates have been trending down since 1981, so we are more than 35 years into a declining interest rate structure, so we must be close to a low in interest rates. The only question here is the economic recovery in the US began in June 2009, so we are 6 years into an economic expansion. This is historically the third longest expansion. We have been 6 years. March 2009 low, S&P 666. We went over 2,100. So we're over 6 years into bull market. Then I say to myself, I see the global economy weakening, and I see French, Italian, and Spanish bond yields lower than US Treasury yields. So with the view that most people have that the US dollar will remain relatively strong, I say to myself, everybody is bullish about stocks in the US and everybody is bearish about bonds. And I say to myself, maybe Treasury notes, the 10 years and the 30 years, as an investment for the next 3 to 6 months, maybe not so bad. And then I also advocate in my investment strategy always diversification between real estate, equities, bonds, cash, and precious metals. And if someone comes to me and says, Mark, you're bearish about the world, shouldn't you be all in cash? I say, yes, maybe that is correct, except if I put all my money in cash with the banking system, I take a huge risk, because we've seen it in the case of Greece, we've seen it in the case of Cyprus, and now they announced that basically investors, if there is again a crisis, they will also have to pay something. So if you have, say, $20 million with the banks and they have a problem, maybe you only get 50% back. So I say to myself, rather than have the money in the banks, I have it in treasuries.